There are moments in banking when risk is no longer about balance sheets, compliance, or capital adequacy. It becomes existential. Moments when a country or an entire region's connection to the global financial system literally hangs by a thread. And when the very institutions meant to protect the stability of the financial system begins to threaten it. In our last podcast, we explored 5 key risks that indigenous Caribbean banks will be forced to confront in the event that the current geopolitical tensions in the Middle East continues to deteriorate. In that episode, we concluded that the most significant risk that Caribbean banks will have to face is the potential risk of de-risking. In this episode, we tackle the topic of de-risking head-on by going back to the year 2014 when the Caribbean region and Caribbean banks were confronted with this risk and this threat. In order to fully understand the concept of de-risking, it is helpful to first have an appreciation of correspondent banking and an understanding of the role which it plays in coordinating and facilitating the global financial system. Most banks in smaller developing countries, such as the Caribbean, do not have a physical presence or license to operate in major global markets. Consequently, in order to move money internationally, they must rely on large international banks which either have a physical presence or relationships in those jurisdictions. At its core, correspondent banking is a system where one bank, the correspondent bank namely, usually based in a major financial center such as New York or London, provides services to another bank, such as indigenous Caribbean banks, thereby enabling these banks to conduct international transactions such as payments, trade finance, and foreign exchange. Absent this mechanism, businesses based in the Caribbean would be unable to pay for goods and services purchased abroad or to even receive payments for goods sold to its customers abroad. Put simply, correspondent banking is at the very heart of global finance and world trade. Starting in 2014, Caribbean banks and financial institutions began seeing a dramatic decline in correspondent banking relationships, with the World Bank citing the region as the most severely affected from a global perspective. In addition to the World Bank, a 2017 survey by the Caribbean Association of Indigenous Banks highlighted the fact that 21 of those 23 Caribbean countries had lost at least one correspondent bank in the intervening period. Of all the Caribbean countries affected, Belize was literally the tip of the spear, with one major bank in that jurisdiction at one point losing all of its correspondent banking relationships. This process of the withdrawal of correspondent banks from providing traditional services became known as de-risking, and needless to say, had far-reaching and in some instances, disastrous consequences on the underlying economies. What led to this de-risking phenomena? What were its direct implications on the banks and the regions affected? How did the banks respond? What, if anything, can be done to avert a recurrence of the same? With the geopolitical tensions rising in the Middle East and a global financial crisis no longer a remote possibility, these are some of the questions and issues which we plan to tackle in this episode of our podcast. First, the causes of de-risking. Why were regional banks de-risked, starting in 2014? And how did the correspondent banks rationalize their decisions to leave a region which they had dutifully served, in some instances, for more than 5 decades? So what was the catalyst for the de-risking crisis in the Caribbean? While initially reticent to provide overt reasons for the curtailment of their relationships with Caribbean banks, it eventually emerged that the primary driver behind the decision to leave the region was the rising compliance cost imposed in part by regulators on US and European banks coupled with a declining risk tolerance related to AML as well as terrorist financing risk. In addition to these two issues, Caribbean banks face an additional problem. Correspondent banking is typically a fee-based service, and the relatively small Caribbean banks did not generate a sufficient volume of payments to cover the cost associated with servicing them, especially in an environment of increasing and rising compliance costs in the United States and Europe. So what were the direct implications of this crisis? At first, Caribbean banks did not lose access to their correspondent banking relationships entirely. But what they did lose was efficiency. The simple act of sending a wire or making a foreign payment on behalf of a customer, something that should typically take hours, maybe a day, suddenly became a very costly and uncertain exercise. No longer having access to their traditional service providers, such as Bank of New York, Bank of America, Citibank, and Wells Fargo, to name a few, Caribbean banks started relying on smaller US banks and non-traditional service providers in the United States and elsewhere. By having now to rely on smaller correspondent banks, and in some jurisdictions, those jurisdictions most severely affected on fintechs, wire transfer fees did not just rise, they literally exploded. In some jurisdictions, such as Belize, wire transfer fees jumped from $25 per transaction to as much as $300 per wire. Just think about that for a moment. A tenfold increase in fees overnight. For bank customers having to remit funds on a recurring or monthly basis, this was a financial nightmare. During this period, Caribbean banks were literally scrambling, searching for alternative correspondent relationships, trying to keep the system functioning. And it wasn't just cost, it was also time. Transactions which typically took a day to complete now took weeks, 2 weeks, sometimes 3. Imagine being a business owner in Jamaica, Belize, or St. Lucia, having to call your overseas supplier and explain to them that your payment was actually made, that you sent it already, but that you just could not confirm when it would actually arrive in their account. Such conversations as these became routine. This kind of uncertainty, however, in business, doesn't just strain relationships, it damages credibility. And in international trade, credibility is everything. As if that was not bad enough, then came the second order effects. Large corporate clients, customers who had long-standing relationships with their suppliers in the United States and Europe, began to feel the pressure. Credit lines, which were once reliable, often stretching for 30 to 90 days, started shrinking. In some cases, cut off completely. Suppliers, now wary of delays and settlement risk, tightened their credit and payment terms, further exacerbating an already tenuous situation. The ultimate and inexorable consequence of all of this was that Caribbean banks, through absolutely no fault of theirs, were suddenly perceived as higher risk. With a high concentration of international and offshore banks operating in the jurisdiction, this sector, the offshore banking sector, also began to feel the strain as well. With clients unable to move money freely between jurisdictions, the entire offshore banking ecosystem began to seize up. The loan portfolios within the offshore banking sector began experiencing higher levels of delinquency and in some cases defaults. Not because the clients and borrowers did not have the ability and the means by which to pay, but because traditional payment rails previously provided by correspondent banks were now all gummed up. Access to foreign exchange by domestic customers and regional banks also became a major pressure point during this period. Perhaps one of the most alarming impacts of the de-risking crisis was the impact which it had on foreign customers who retained deposits at Caribbean offshore and international banks. Here, customers began experiencing something almost unthinkable. They could not access funds held in their accounts, not because the banks were insolvent or illiquid, but because they were effectively cut off from the global payment system. No wires in, no wires out. Against this background, some depositors had to literally travel to the jurisdiction in order to withdraw their deposits in cash. And as you would expect and imagine, in this scenario, legal threats began to emerge. But the reality was this: the regional banks were not the root cause. They were caught in a system-wide shock, a shock driven by global regulatory pressure and the retrenchment of correspondent banking relationships. A shock, alarmingly, not unlike what can potentially unfold in the event that tensions in the Middle East continue to exacerbate and to percolate. So against this background, I ask what I think is a very logical question. If de-risking reared its ugly head in the Caribbean once again, would Caribbean banks be ready this time around? The first wave of de-risking taught Caribbean countries and indigenous banks some very hard and important lessons. We saw a dramatic withdrawal in correspondent banks from the region. Wire transfer fees spiked dramatically. Some jurisdictions were plunged into a foreign exchange crisis. There was a significant uptick in due diligence, and in the most extreme cases, the region experienced what could only be described as financial exclusion at a national level. Caribbean banks were forced to find workarounds. Some were forced to rely on intermediary institutions and fintechs, while others simply reduced services to entire categories of customers. Across the region, one truth became patently clear: dependence on a small number of correspondent banks based in the United States and Europe was a systemic vulnerability. So what can Caribbean banks do to avert this single point of failure as we closely follow the unfolding crisis in the Middle East? Here, I offer 5 critical imperatives. The first is this: that compliance must become a strategic imperative. This is no longer about simply ticking boxes and perfunctorily filling out forms. Caribbean banks now need to build on the platforms which they constructed during the first wave of the de-risking by ensuring that their AML monitoring and compliance systems are proactive, real-time, and transparent. In addition to this, regional banks would need to become radically transparent with their correspondent banks by moving further along the communication channel, by openly sharing compliance frameworks, and perhaps above all, continuous engagement. The third thing which must be done, and this is extremely critical, is that there must be a dramatic increase in regional collaboration amongst indigenous banks. Individually, Caribbean banks are small. However, collectively, they represent an attractive value proposition. Against this background, the future must include shared KYC on your customer utilities, regional compliance platforms, and coordinated engagements with global correspondent banks. The fourth and fifth action which Caribbean banks would have to take should be quite obvious. Digital transformation has to be an integral part of the solution and the preparatory work of Caribbean banks. There therefore needs to be an increased emphasis on digital payments, electronic KYC, and data-rich transaction trails. It also goes without saying that there must also be diversification of correspondent banking relationships and a recognition of the important role that fintechs and non-banks play in this space. Regional banks must build relationships across multiple jurisdictions, explore alternative payment rails, and engage with fintechs. The objective here should be clear. There must be no single point of failure. As we bring this episode to a close, let us be clear. De-risking is not just a banking issue. It's a development issue. It debilitates trade investment, credit card payments, letters of credit, and remittances, just to name a few of the foundational and critical banking services that it can handicap. The first wave of de-risking, which the region experienced starting in 2014, was a warning. The second wave, if it comes, will be a test. The question, therefore, is not whether the global financial system will change. The real question is whether or not Caribbean banks will be ready. Something to think about. A word to the wise.